Welcome to the Remarkable Retail Podcast, the only podcast hosted by two of the NRF's top retail voices. I'm Michael LeBlanc.
And I'm Steve Dennis.
Our guest on this episode is James Daunt, Chief Executive Officer of Barnes & Noble, the world's largest retail bookseller, of stationery and gift retailer Paper Source, of Waterstones. He's CEO of all these things, the largest bookseller in the United Kingdom. Mr. Daunt currently oversees more than 600 Barnes & Noble bookstores, 125 Paper Source stores in the United States, 300 bookshops across the United Kingdom, Ireland, the Netherlands, Belgium, Waterstones, Blackwells, and the list goes on. Now, of course, first we'll be bringing the important retail and war news of the week, it seems. And then after our interview with James, we'll be back with our remarkable stories of the week and what's on our radar screen. Now, Steve is a best-selling author of 2 books. Did you hear some encouraging news about the book retailing industry from James?
I did, and I have to say, and maybe people might remember, I shared a little bit of skepticism over the last few years about Barnes & Noble's renaissance. But it appears to be real, and folks will hear what's behind that and where they're headed. And James is just a really interesting guy, if only, but there are many more reasons for this, but if only because his view of the retail world and strategy is kind of counter-narrative or countercultural or quite different than I think the way we see a lot of people approach it. So I've been working to get him on the pod a while. And I think people will really find it interesting.
Now, we'll also have a big announcement. We are happy to partner once again with Commerce Next, great folks at Commerce Next, as the official podcast of the Commerce Next Growth Show, coming up in New York City this summer, June 23rd and 24th. We'll have more news on what that looks like, and there will be a discount code in the show notes. We encourage you both. It's a great show. I would love to see you there. And as I said, an offer code in the show notes. Now, Steve, since we are talking about the written word, give the people an update on your Substack, Pardon the Disruption.
If you haven't subscribed to my fairly new still, Pardon the Disruption Substack newsletter, please do so. Already at over 10,000 subscribers and well over 100,000 views, even though that's I'm on, I don't know, number 9, number 10, something like that. Tell your friends as well. So recommend it on Substack, share it, like and subscribe, all those kinds of things.
All right, let's get to the news of the week. We haven't done this for a couple of weeks. We're going to start on the kind of the macro because there's so much moving around, both news that happened before the war started and news that is being driven by the war. So kick us off.
Yeah, really quickly, outside of the war, just as we're recording this, we've got some news on the U.S. economy, and GDP growth actually was revised downward to under 1%. So that is certainly not quite robust. We also got some inflation data, which shows that inflation's kind of stuck more or less around 3%. Now, all of this is before, this is really December and January data, so this does not reflect anything coming from the war. And the other thing was, as you kind of parse out some of this data, business and government spending, including defense spending, was down a lot. Now, presumably that is going to start to shift in the other direction. So we'll see how this all mixes out. But consumer spending was really the thing that kind of carried the day. And as we start to talk about the Iran war impact, that's really a big question mark. So moving on to that really quickly, in the third week of the Iran war, I guess, as we record this anyway, the trajectory is pretty unclear, but we're getting a little bit better handle on both the direct as well as the ripple effect. So oil prices being the easiest to see, going up quite a bit. Goldman Sachs estimates that gasoline prices will be at least 20% higher for the entire year. This isn't just kind of saying what's going to happen over the next several weeks. And as we talked about last week, the U.S. is actually more insulated from gas prices than really just about anywhere else in the world. There are definitely some people that think that oil prices could go much, much higher. I suppose a lot of that has to do with whether we start to see ships moving through the Straits of Hormuz. A couple other things I'll just mention quickly that I saw some economists talk about, which is that oil prices, typically their impact on consumer spending typically lags a bit. Now, apparently, the data that some economists have looked at is if there's an oil price spike, consumers in general tend to first go towards savings rather than reducing spending. But obviously, not everybody has a lot of savings to go to, and the degree to which oil prices are high would start to impact that. But the impacts on discretionary spending are, and I guess this makes sense if you stop to think about it for a few minutes, are quite different depending upon where you are in the economic spectrum. If you're affluent, then, maybe annoying the gas prices are high, but it doesn't necessarily really affect your spending very much. Whereas you go down, it starts to be a bigger deal. I guess the other thing I'll mention quickly is, and I found this really fascinating. One thing was surprising. The other one I hadn't thought about very much, which is, of course, big component of airlines' pricing structure is fuel. And so not too surprisingly, we're seeing airfares go up around the world, but we're actually seeing some airlines cutting flights. Basically, I guess the calculus is gas prices are so high, we cannot fly these routes profitably. So they're starting to cut flights. So it appears to be fairly isolated as we record this, but I think that's something to keep your eye on. And then I was going to ask you, because you understand the food industry more, there's starting to be a lot of worry that food prices are going to be affected quite a lot. And that's not maybe so obviously tied to oil prices, but I think you have a little bit more perspective on that. Maybe you can make a comment on that.
Yeah, there's a couple of things that drive the cost of food. First of all, diesel is very important, not just oil. And of course, the world moves on diesel. So the cost of moving all these goods from coast to coast, all those trucks, all those boats, that will follow its way into the price takers and farmers. And then secondly, fertilizer. It is planting season in the northern southern hemispheres, and that takes a lot of fertilizer. And the inputs to that fertilizer are stuck. Literally, there's 10,000 crewmen who are stuck and can't get through the Strait of Hormuz. It's been like 10 days. You don't recover 10 days. As you said, it takes a year for this. So this will very quickly start to ramp up into food inflation. We saw that in the Ukraine war. We had the same phenomenon. They're a big source of fertilizer, for example. So these inputs into the food chain, they don't happen immediately, but they start to happen actually fairly quickly, particularly in fresh. There's a lot of produce that comes from that part of the world. I enjoy my fresh fruit from Egypt, and I've got stuff coming in from South Africa. It's all disrupted now.
Yeah.
Right.
Yeah.
It just, the ripples are global. So we should, now the good news about the U.S. economy, it's been in very, very strong economy and can absorb a lot of shock. Unlike Canada, we had the highest food inflation, 7% in the G7. Listen, without a doubt, food prices are going up, period, for the rest of the year.
So, kind of related to this, I was listening to Ryan Peterson, who some of our listeners may know. He's the CEO of Flexport, which is very involved in the logistics business. And as you were talking about, obviously, fuel prices affect the cost of freight. But the other thing he was talking about, which I guess I had not really had any reason to think about very much, is that 18% of all air freight is controlled by Middle East-based carriers. And the Dubai airport is the number one freight airport globally. So not that the pricing isn't an issue affecting these things, but literally the ability to have the airplanes available and the routing available to do air freight is being affected. So again, we'll see the direction of this. The Dubai airport is open as we speak, but on a reduced schedule, as is Doha, as is Abu Dhabi. Now people are, rerouting and doing all sorts of things, but another impact of disruption, which looks like it's going to be with us for a while. The other thing I'll mention really quickly, which is really more related to tariff spending, which I'll maybe touch on a little bit later in the show, there's a lot of things going on to get ahead of the new tariffs that may be coming from the Trump administration. So this is also causing people to maybe accelerate shipments, shift things, but they're doing this in the context of higher freight rates. So it's crazy. So last thing I'll say that's really macro related is the interest rate narrative is starting to shift. So many people are probably paying attention to this, but kind of coming into the year, there was a sense that not only the US, but other governments would be bringing interest rates down. Of course, the hope for that would be related to big ticket sales, the home market, mortgages coming down, all that kind of stuff. Well, that's starting to shift because of the worries about inflation, all the things we just talked about. But also, the U.S. government is spending $2 billion a day on unexpected spending that is going to contribute to the deficit, which is already increasing. And of course, to the extent growth slows, which it seemed like it did last quarter without the Iran war, with any luck, most obviously for humanitarian reasons, the fighting will stop. But also the potential impact from all this continues to be perhaps quite damaging.
Yeah, and I'd pile on with one last thing, insurance rates. Imagine being an insurer about
Right.
getting a phone call. Hey, I'm taking my boat through that strait, and I think it'll be fine, but what's my rate today? That's going to be a very, very, very high rate. Let's move on to quarterly earnings. Now, many of these, of course, earnings were results before the war, but the outlook is certainly probably shaped by the war and all the things we've been talking about. Kick us off with Kohl's.
Yeah, if you go back to what we talked about the last couple of weeks, that was really before the fighting had broken out or had just gotten started. And I think there was a view back then that maybe this is just a few days, and that's obviously not turned out to be the case. So this is really the first where the knowledge of this started to affect what was said on earnings calls. Kohl's, the mid-market department store, continues to go nowhere fast. I always talk about this as the collapse of the unremarkable middle. They're kind of the poster child or one of the poster childs for this. So comp stores were down nearly 3%, while the categories they're in have had strong positive sales overall. They did improve profitability. This is mainly because they've been taking some costs out. I would argue, based upon some of my store visits, they may need to put a little bit of cost back, but maybe that's a different topic for a different day. They did show a little bit of gross margin improvement, but again, from my store visits, there's still a ton of clearance merchandise, and I don't know, there's probably more to get into there than we have time for. Neil Saunders, frequent guest on the show, and we'll have Neil back on in a few weeks. He pointed out on LinkedIn that since 2019, Kohl's sales are down a pretty astonishing 24%. Overall retail, and those categories are up quite a lot. So this is a business that has been struggling for quite a while. Anecdotally, just to kind of pile on to some things I've said, I frequently visit several Kohl's stores, and their execution is really terrible. I would say it's very hard to figure out what they really stand for. And really, Sephora, which is in pretty much every Kohl's store, is really the only good part. And I think I've made this comment before. The contrast between the Kohl's value proposition and how it's executed compared to the rest of the store is quite stark. Anyway, you might expect that they might look at closing a lot of stores. Their newish CEO, Michael Bender, said that they're really not looking at that too seriously because 90% of their stores are profitable. So when you hear that, on the one hand, it's kind of encouraging, but it does say that quite a lot of stores are unprofitable today. But also, if they can't get the top line going, the numbers of unprofitable stores will presumably grow. And the outlook they gave was that they did not really expect sales to turn around anytime soon. So anyway, I think that's very much a moving target. I guess the good news is that Kohl's has a decent balance sheet. They don't have a ton of debt that's due very soon. They actually have pretty solid cash flow. So there's not a crisis bankruptcy kind of situation here. They're just, somewhat kind of walking dead at this point. So anyway, more to come on that. Now, on the better news side, Dick's Sporting Goods, a retailer that we really like, had pretty good results, though it's kind of a mixed bag. And the mixed bag is, first of all, if you compare it to Kohl's and take this kind of 5-6 year perspective, Dick's sales are up nearly 30% since 2019. And that's a mix of solid comp store sales as well as quite a few new stores. This quarter, to quote Neil Saunders, again, was a bit of a tale of two athletes, if you could use that language. And that's because, as some folks might know or remember, Dick's Sporting Goods acquired Foot Locker. And while Dick's comps were pretty solid, Foot Locker comps were not. They were down negative 3.4%. And that was a big drag on net income. It's a little hard to sort this out because they are going through some transition costs. They are rolling out some new Foot Locker concepts. So they're really just starting on the restructuring, of course, with the hope that will, there will be some one-time costs, which will allow them to improve profitability, but they'll start to be able to drive the Foot Locker comps positive. So that's a bit of a wait and see. But Dick's keeps rolling along with growth. Mm-hmm. They are rolling out their House of Sport locations, which we talked about on a prior episode of the pod, which is kind of their new improved version of being a category killer, which looks to be quite promising. They're also opening 22 Dick's Fieldhouse locations. So Dick's has been very aggressive about experimenting with new concepts. And I guess you could say they're beyond the point of experimentation because they are investing pretty heavily behind it.
To wrap up our news segment, lots of news coming out of Saks as part of their overall reorganization. What are the top notes?
Yeah, I'll try to make this quick, but I think, there's some good news in one way of looking at it, in that the reorganization really seems to be picking up speed. Geoffrey van Ramsdorff, the newish CEO, did a couple of interviews, and he sounded a pretty optimistic tone. But of course, they continue to deal with their store portfolio. So this past week, they did the third and really the most significant round of closings in terms of announcing 15 full-line stores closing. It's 3 Neiman Marcus stores and 12 Saks Fifth Avenue stores. Now, 4 of the Saks Fifth Avenues were in smaller markets, 3 in the same mall as the Neiman Marcus, or where Neiman Marcus has a location. So one of those is Las Vegas, which you and I have visited and talked about. One people may know, if they've spent any time in Chicago, is on Michigan Avenue. It's right across the street from the Neiman Marcus store. So these are really pretty much in line with what I thought would happen. The thing I'll just make a quick comment on, because this is pretty easy to get into the weeds on, a few that have not been announced as closings were a little surprising to me, because they are in the same mall. They're locations where they coexist, Neiman Marcus and Saks Fifth Avenue, in the same mall. Now, I think 2 things might be going on here. One is that actually the Neiman Marcus and Saks might be able to coexist if Neiman Marcus is more clearly positioned on the luxury end and Saks is more accessible luxury. Now, they have been, that's kind of the situation that has emerged over the last few years anyway, I'm assuming, but I don't know for a fact, but based upon some things that Van Ramsdorff said in the interview, that there isn't as much overlap between the Saks Fifth Avenue and Neiman Marcus customer as historically has been true, and that is because of some of the shifts that have gone on over the years. But it sounds like maybe they're going to push that even forward. So it's possible that some locations like Houston Galleria, Bell Harbor, et cetera, might be able to coexist. The other thing, though, I think is going on is that they're still working out and negotiating with some of the mall owners, because it's quite problematic. And I'll just use my Boca Raton example, where there's 2 very nice stores, a Neiman Marcus store, Saks Fifth Avenue store, that are a few hundred yards away from each other. They look very, very similar. It's hard to imagine that you really need both of those stores, but it's not a huge mall. There's 3 anchors, not 4, 5, 6, as we see in some places. And if one of those stores were to go dark, and in this case, Simon Property Group is the owner, they don't have anything to go in there. It's not a good look. So we've already talked about Simon Property Group going through these repurposing. It's probably not a shock to them that Saks Fifth Avenue might want to leave there, but they may not be able to shift their plans to redevelop that mall so quickly. So they might need a little bit of time. So I'm just using that example. There are some other examples. I don't have any inside information about that mall in particular, but I can imagine a scenario where Neiman's might say, well, look, we're going to close. You got to help us out here. Maybe the mall owner says, we'll, no rent, but just, sign an extension for 2, 3, 4 years while we get our act together. I could imagine that happening and there being mutual interest. So time will tell. We'll know a heck of a lot more over the course of the next month or 2, I would expect.
Well, speaking from experience here, with so many Hudson's Bays and Nordstrom's closed, it's a locked door to a parking lot, right? And it's a dark end, and it's a dead zone of the mall. So the fellow retailers really feel it. And to your point, there's a lot of reasons to keep those doors open, even if people are just cutting through to get to the Nordstrom or the other stores, particularly the mall owners. So it's a good rationale. All right, well, that's a wrap on the news. Let's get to our great interview with James Daunt from Barnes & Noble, and then we'll be back with our remarkable story of the week and what is on our radar screens to wrap the show.
Well, James, thanks for joining us on the Remarkable Retail Podcast. We're so excited to have you. How are you today?
Oh, good. Thank you. And thank you for having me.
You've actually been on our list for a while, so we're excited we made this happen. Where are we finding you today? Just so our listeners know.
I am above the bookstore in New York City.
We have a lot to cover, so we might as well just jump in. But for folks that may not know that much about you or your journey, somehow or other, you became the CEO of the world's biggest operator of bookstores. So I wonder if you could just give us a little bit about how you ended up being in the bookstore business and how you ended up doing exactly what you're doing right now.
I set up my own bookstore back in 1990. When dinosaurs were, or shortly after dinosaurs left roaming the earth, and been a bookseller in my own bookstore for 21-ish years, and then the equivalent of Barnes & Noble in the United Kingdom, Waterstones, got into trouble. Didn't quite go bankrupt, but was on the precipice of bankruptcy, and I took over there as CEO with a Russian gentleman who bought out the business. Ran that from 2011 to 2018 or so, when it was acquired by a private equity bunch, and the following year they bought Barnes & Noble, the US bookseller, and I've been doing the same here and continuing to steer the good ship Waterstones in the United Kingdom ever since.
Were you a big reader? Were you really or trying to be an entrepreneur? Like, how did you even get into it in the first place? Was it sort of an accidental leap in a way?
Yeah, accidental leap. I went to university, got a job in a bank because they paid well then as now, and it was fun because it was New York City, and after a very short time, my then girlfriend, and happily I married her and still married to her, decided that was a pretty terrible way to be living my life, and just said I needed to do something else. And I sat around for a short while, sort of twiddling my fingers, trying to work out what to do. But I read a lot. I love reading. I like traveling. I couldn't quite work out how to marry a living with traveling and keeping. The main problem with banking was that I was traveling all the time. So I set up a bookstore.
Well, it's quite an amazing journey. And of course, we want to get into the strategy and some of the great success you're having. But just for some people that may not appreciate the scope of what you do, we have a U.S. audience, but a big international audience as well. So our U.S. audience, of course, would know Barnes & Noble. The U.K. audience would know Waterstones. But maybe just kind of sense how many stores, how many different nameplates, just so people kind of know where we're starting.
Well, obviously, the most important one is Daunt Books, which is undoubtedly the best bookstores in the world, which is London. So my own bookstore is on Marylebone High Street, the initial bookstore, and is still there and is still, as I say, the best bookstore in the world. Waterstones is 340-ish bookshops, but under a lot of different names. There's Waterstones, but there's also Hatchards and Blackwells and Foyles and Hodges Figgis and quite a few others besides. But it is by far and away the largest bookseller in the United Kingdom. And then Barnes & Noble is obviously the largest one in the United States. And that's about us. We have some bookstores in Ireland and one in the Netherlands and one in Belgium.
You know, if we cast our minds back a few years ago, this media narrative, the canard really was this retail apocalypse, and wrapped up in that was the death of the physical bookstore. Physical books, for that matter, period. Everyone was going to be reading books on readers. But, it's been declared that many, many times that the physical bookstores have no role, but you've not only proven them wrong, you're growing your store count. So it's a big picture. What did you see that others didn't?
Well, I suppose I had the great advantage of running my own bookshop and knowing that was going very well and perfectly well, and that Amazon was, fundamentally not a problem. And Amazon is an online retailer, let alone Amazon is a purveyor of Kindle and ebooks and subsequently audiobooks. Because if you ran a good bookshop, a friendly bookshop, and an interesting bookshop with nice booksellers in it, people were very happy to come into it and enjoy it and buy books from it. And the theory was that if we did the same in Waterstones up and down the land, that we could turn around those stores, and we proved it really quite quickly, despite the fact that Amazon was letting rip both as an online retailer, but also Kindle was fantastically successful. This is back in, took over in 2011.
You were explaining that, really the formula was fairly simple. Make a compelling place that's, Steve might say, a remarkable place people want to remark upon and be there. It sounds very simple, but, what did you, when you took over Waterstones and then, carried it through to Barnes & Noble, who were in similar positions, whether bookstores are interesting, both businesses were under considerable pressure. What are the first couple of three things that you did to unpack that big picture objective of make them an interesting place to go where, you have great product?
Well, you have to change the culture of the place and also the way in which the stores, each individual store itself, was being directed. And my theory was that if you let the store team decide how it wanted to present its store and really concentrate on giving the best possible service and make the most interesting store, that each of those individual teams would be able to make vastly better judgments than a central direction, which was sort of fundamentally how both Waterstones and Barnes & Noble operated at that point, and were very structurally embedded within that endeavor to run a very compliant, consistent bookstore up and down the land. And one of the reasons that they wanted to do that was not just because they were a corporate retailer, and corporate retailers always want to do that, but also that a lot of the money was attached to that because they would sell the position of the individual books within a store, from the bestseller list to the tables to the front presentation. Publishers would pay for placement, and that drove a lot of the economics of the business, but also created these very homogenous, very dispiriting, rather soulless stores, and also stores in which the booksellers themselves, were having a pretty tough time working and enjoying the process of working, because most of the skills that are attached to good bookselling were being denied them. And it also happened to be very, very expensive to do. You need a very large home office to be able to run that consistency. It was really hard work, and quite inefficient. And I just dispensed with all of it, which had the disadvantage of also foregoing the publisher's check. But it meant that we could have a much smaller home office, run the place much, much more efficiently at a lower cost, and begin to run much better bookstores. So our sales started going up. And that equation, and I did have the great advantage of both businesses being effectively loss-making or barely profitable at all, of knowing that model didn't work, so a different one had to be tried.
I have to say, a few years ago when I heard about some of the things that you were doing, while I liked the idea of pushing down decision-making to the local store level, it was a little bit hard for me to believe that what seemed like relatively incremental change would have such a big result. But, being a product of a big corporate world, maybe that's my bias going in. But I also wondered, because you do have quite a lot of stores, what sort of complications does that bring to it? Are you using technology in any significant way to support that local execution? Could you just talk a little bit about how that works?
Well, I think the fundamental leap of mind that has to be taken from a corporate sense is that if we are to let the individual stores run their own stores and price books as they wish, place books as they wanted, reorder books as they judge best, many of those stores will get better, and that's great, but a lot of them are going to get worse. And you just have to accept that. So there is a divergence of performance that happens initially. And my sort of philosophy there is, well, you're going to have to take a step back in order to take one forward. And from our perspective, and both centrally but also at a local level, recognize the guys who go backwards and support and change them, and use the people who've gone forwards to do that. And that's the local element. But you do have to accept a significant deterioration in some of your stores. And that's quite difficult for big corporations to do, but I was quite comfortable with that. And indeed, we continue to have some really quite shockingly awful stores, but we also have wonderful ones. And my job is to get the wonderful ones to support and help and improve the terrible ones.
Not for nothing, but I think that's the title of the episode, because it's good clickbait, just saying as the producer.
Yeah, I appreciate the honesty.
We'll be right back with our interview with James Daunt, CEO of Barnes & Noble, right after these messages. The biggest names in retail don't guess. They use Placer AI. Placer's location intelligence platform turns foot traffic into real strategy, giving you near real-time insights into market share, cross-shopping trends, and trade areas for any location in America. Whether you're entering a new market, tracking a competitor, or optimizing your existing footprint, Placer gives you the data to decide with confidence. Visit placer.ai to see it in action. Today's episode is presented by Find Mine. Outfits, vibe, and trends are what your consumers eat up on social media. Are you capitalizing on them? Or do your experiences feel static or take too many hours to build and maintain? Listen to this. Find Mine delivers on-brand inspiration to over 100 million consumers every month. Lululemon and Ann Taylor use Find Mine's content engine to turn their catalogs into complete looks, better visual similar swaps, and on-trend programmatic ads, improving LTV, CAC faster than any other activation. Now, you can get live fast in as little as 1 week without enterprise contracts or waiting on a product backlog. Check them out at findmine.com.
Can we talk a little bit about store design and the evolution, I guess, of how you execute? I've been in quite a large number of your newer stores, but also I'm aware of quite a few stores that are, more sort of the 90s vintage, which are maybe 2 levels, quite large, maybe need a bit of a refreshing. How much do you think being able to get certain stores to a more modern look, to maybe a different size, different layout, has helped drive your success?
Well, definitely. And our job is always then to juggle what at the early stages of the turnaround is not very much money, and how do you best invest that to generally to provoke overall improvement. And I'm pretty simplistic about it and divide it into quarters. I'm going to have the mathematical abilities of most booksellers, which is just keep it simple and you'll probably be all right. But we invest roughly quarter of what we make in just the fabric of our stores, because escalators don't work, HVAC doesn't work, just making them the core things work better in, as you say, a lot of old stores. So we could spend all of it on that and still wouldn't have spent enough, but we just put a quarter. We spent about a quarter on the IT and the distribution center, so just the things that allow booksellers to run their stores a little bit better. Again, we could do an awful lot more, particularly in the IT infrastructure, but we allow a quarter. We put a quarter into new stores, because if you're not growing, you don't have career opportunities and you're not able to attract people to you in the same way. And also new stores are much easier to run and much more profitable and nicer looking generally. So they will make you more money, which you can then reinvest. And the final quarter, and probably the most important quarter, and I wish we could do more, but we hold to that discipline, is in pay. So improving the pay of booksellers, making it a better place to work, and allowing people who are devoting their careers to it. And it's quite a vocational commitment that you have to be a bookseller, that they are able to be paid more. So, and as you do better, you're able to, obviously each of those increases steadily as the business prospers, but you hold to that discipline of allocating it in that way.
Very interesting. So I'll pass the mic back to Michael in a second. But one other thing I wanted to get your take on, because maybe I have the wrong impression, but my impression is that the book industry is pretty well dominated by relatively few big hit titles. And you already talked about how you've broken away from being, I guess, subservient to the publishers. But in an environment where it seems like there's so much focus on relatively few titles, and then you have, this kind of long tail assortment in your stores. Well, I guess, first of all, is that true, or have you somehow changed the equation in the way the volume is driven? And also just how does that extend to maybe other things that you're selling beyond books within the store? What is that kind of merchandise strategy to maximize the potential of each store?
Yeah, it's sort of true, but not really. Bestsellers do matter because they drive traffic, and people will come in for the latest thing, and then you can sell them other things, and it also embeds the habit of coming into bookstores. What we have done is change the nature of those bestsellers. And I think it had become quite moribund, both in the United Kingdom up until the point we took over at Waterstones, and was definitely so in the United States. So the same people dominating the bestseller list year after year. Some of them actually, sadly, having left us altogether, and it was just their brand names, writing, as it were, from the grave. But not much change. Grisham and Patterson and Michael Connolly and all of those guys who are great writers, but not much new. We've continued to sell them, but also become much better at getting ourselves behind new voices, creating the bestsellers of the future, which hadn't been happening. And that's done through bookseller recommendation, essentially. Been very much aided in that as social media has allowed customers and readers to because everyone wants to read the same book. There's been always been a huge excitement, particularly amongst young adults, amongst books, whether that's Twilight and Harry Potter and all of those things. But now it's romantasy, and it's Sarah J. Maas and Rebecca Yarros and lots of others. But social media has made that quicker and more exciting, much more violent in the rise of these authors and the sales that are attached to them. And the bookstores have played physical bookstores have played a very important part within that. So we've benefited hugely from that phenomenon. But at the same time, whilst that's going on and that sort of captures the oxygen of publicity, most of our sales are in the backlist, and that still chugs away and delivers probably 80-ish% of our book sales. People still come in and buy for their kids and buy picture books, and Goodnight Moon is still a bestseller year in, year out, as is the great canon of literature and the backlist generally. People still buy cookery books and diet books and personal growth and business books and whatever it is. Some of them go up and down with the passing of the seasons and indeed the passing of the years. But that's 80% of what we do. And then if you're a very good bookseller, you sell people an awful lot of things that are not books alongside books, but in a complementary manner. It depends on the size of your stores as to how extensive that range is. But our larger stores are also places in which we are very, a category dominant destination retailer for things that are not books. So toys and games, newsstand, we're the biggest. We have a really fantastic newsstand offer. Media, which is now dominated by vinyl, but still sort of rather improbably includes DVDs and CDs whose sales are going up. And toys and games, particularly educational ones, board games, that's educational, it's supportive. We do quite a lot of collectible things around which are attached around things like Pokemon, which are associated with our graphic novels and all the rest. So we do a lot of things that are not books, and probably it depends on the store, but overall in the United States with these big stores, 40% of your sales can come from things that are not books, but they make perfect sense to be in a bookstore, and people coming into a bookstore enjoy buying them, or in the case of our cafe, just enjoying the hospitality of the cafe while they're in the stores.
It's interesting listening to you. A bookseller here in Canada once described her stores as cultural department stores, where they're trying to always get that mix right, driven by booksellers. Does that resonate with you? Do you think of it in that context, or is it just a merchandising mix that is associated with?
No, I'm that. I firmly believe in that, and I'm very rigorous about it. So we've thrown out all the things that didn't quite make sense within a bookstore, but which we would be selling really quite a lot of, and which other booksellers are very successful with. And actually. Indigo, which is the big bookseller in Canada, remains extremely proficient and successful at, but which we don't do. They do lots of household goods and the like, which we figure is just too difficult and complicated, and also doesn't for us belong with imagination and reading and the essence of what we are as a bookseller.
Let's one last question about your stores. How are you with your store fleet using your bookseller math? Do you have the right number of stores? Do you have a goal in mind, larger or smaller? And of course, you've got a real mix, right? You've got new stores, larger stores, older stores. How are you feeling about the fleet, and where do you want to take it?
Yeah, we close about 15-ish stores a year. It's a fleet of 700 at the moment. So we're always going to have stores that close, and that's because landlords redevelop or the mall, dies, and then finally we'll be the last one standing, but we'll eventually go as well. What we do now is guarantee to replace those stores. So we protect the jobs, which is the key commitment. It's to our booksellers, but also to maintain a bookstore in a community. Obviously, if a community is used to a bookstore, you've also got a good business rationale for relocating those stores. So we're doing that, but also if we're going to, and I'm absolutely committed to this, to provide really good careers to vocational booksellers, you actually need to expand as well, and offer, if you want to go up the ladder that we have available to us, opening up stores makes that quicker and more exciting for them. We're opening 60-ish stores a year at the moment, and maybe that will grow a little bit because it's a game of percentages, and as the number of stores increases, so the
and
number
we
open will.
Right?
That's not driven by opportunity. That we could be opening an awful lot more, and that's, I'm afraid, a very, very sad reflection on how many bookstores closed in the bad years. Borders has gone, Barnes & Noble itself closed lots of stores, the independents has suffered hugely, and I think that was a collective loss of confidence, and perhaps a few, what now with the passage of time seems unwise decisions. The entire B. Dalton chain was closed, Walden Books bookstore was closed, and then lots of bankruptcies. And indeed, where we've been rescuing a few of the independents who still continue to get themselves into trouble, and they've found hopefully a very happy home within Barnes & Noble.
So as you cast your mind forward for the next few years, is it, and reflecting on what you just said to Michael, is it a little bit, and I don't want to make this sound like it's boring, but is it a little bit of rinse or repeat, like you found, like you've got this formula, you've got plenty of new opportunities to open stores, or are there any other kind of growth initiatives on the horizon? And I don't know if you want to break any news here, but there've been some rumors about an IPO, but is anything that's sort of new and different fundamentally as you look across the next few years?
Well, I think that within the boardroom, there's lots of focus on, presumably IRRs and return on capital and growth and all of those things. My focus is simply on the health of our fleet of bookstores, the health of bookselling generally within the respective countries, and then what we do to contribute to that. And what we do is run ever better bookstores within our existing fleet. And as you say, we've got quite a lot of old stores, so we're investing in their fabric, making them look more beautiful, as well as improving the bookselling within them. And then, growing really as a function of the careers of our booksellers. And that becomes a very virtuous cycle for us. It keeps the guys in the counting house counting out their money happy. But what we're really interested in is good bookstores selling good books.
Last question for you. We mentioned to several of our colleagues that we were having this discussion, and they were very excited to hear an element of transformation and strategy, and many people like a good turnaround story. And could you just share any of your leadership strategies around turnarounds? You've shared a few of them around perspectives, but if you were to give advice to your fellow retailers, what would the couple things be that they really need to focus on to turn around a business or grow a business?
Yeah, I'm not sure that we have that many lessons to offer others, though what works for us definitely does work for us. Internally, it's around the culture of the place, and that has to be a supportive one. It's based around teamwork. We run our stores in clusters of stores, so 5 or 6 stores within which skills are very clearly allocated to individuals within them with clear responsibilities, roles and responsibilities, all about the team. I always ask people to, do the best that they possibly can, respecting those skills, but above all, hold on to 2 things. Use common sense, because common sense gets you an awfully long way, and just be nice to each other, and be very nice to our customers. And if you can do and navigate between those two very simple principles, but quite powerful ones, you'll run, a very good business that people enjoy working for and are prepared to, pull out the finger and go that extra mile, which, at the end of the day, it's a hard work running a store, any retail store. We need people turning up at 9 a.m. and, closing their stores at 9 p.m. and in between, and being very cheerful and hardworking whilst they go about it. And if you're doing that in a very supportive team and a team where everybody is recognizing those who are contributing, you'll get along much better than otherwise.
Well, wise advice. And James, on behalf of Steve and I, thanks so much for joining us on Remarkable Retail Podcast. It was wonderful to get your perspectives. As Steve said off the top, this has been many years where we've had the ambition of having you on the mic. So thank you for helping us fulfill that ambition and joining us on the mic today. And we wish you much congratulations on your success. Wish you much continued success and however the plans fold out.
Pleasure. Thank you very much.
All right, we are back. Remarkable story of the week. Kick us off.
I'm always amazed sometimes to hear data on these companies that maybe we heard of, but we don't get too much detailed information. So Quince, which is this brand that's basically, I'd say, knocks off some of the major luxury brands to sell them at a value price. They've been around for a number of years. Well, they just raised $500 million. And that is a $10 billion valuation. So that's not too shabby.
That's not nothing.
As part of this announcement, we learned that their sales last year were over $1 billion. So that's also pretty impressive and growing at quite a high rate. So if you think about this business, and by the way, still not close to profitable, but of course we've seen that a bunch of times. But if you think about a $10 billion valuation, just for context, for some people that may have a hard time really wrapping their heads around it, that values their company at more than Macy's and Kohl's combined. So draw your own conclusion about what that says about the state of retail. But anyway, that's a pretty impressive number. So Quince is a brand I think for people to watch. I imagine they are hoping for an IPO in the not too distant future, but they have enough money now to at least fund some of those losses for another, who knows, 6, 12, 18 months.
So in the long list of things that I lose track of or just don't simply know, Nestle, you lose track of how big this company is, right? They're a $100 billion company operating in 188 countries, including, of course, the U.S., 2,000 brands, one of which, their retail brand, they sold. If anybody had been to the Oakland-born Blue Bottle Cafe, my experience there was in the Hudson Yards. That was my experience with Blue Bottle.
Mine as well.
Yeah, so they paid $500. They sold it for $400. So they sold it for a haircut or basically a loss. Interestingly, they sold it to the holding company that owns Luckin, which is now probably the largest coffee retailer, remarkably. 26,206 stores globally. They're the biggest coffee. Starbucks, they dethroned Starbucks as the biggest coffee retailer in China. Interestingly, I just think it's an interesting piece of strategy. So, Nestle is actually keeping the rights to the coffee and the RTD lines, the ready-to-drink lines. So, that's just them and a huge, huge portfolio of brands making switches. And I did want to say that I'm getting great reviews, hearing great things about their new Nespresso store in New York City. So we're going to have to visit when we're there for Commerce Next and check it out and see if we can run into George Clooney or Brad Pitt or Penelope Cruz, who are no doubt happy things are going well and they continue to get their residuals. All right. What's on your radar screen? Let's wrap it up.
Well, I touched on this, but I'll add another point is really kind of the new or this next wave of U.S. tariff policy and its impact. I meant to cover this last week, but actually a judge did rule that the tariffs did need to be refunded. And but then the Trump administration said, well, we really can't quite yet because of some logistical issues. So I guess we'll see how that actually sorts out. But as I mentioned earlier, the Trump administration is pursuing a new round of tariffs to make up for the Supreme Court ruling. So number one, we'll see exactly how that works out. Number two, as I mentioned, in terms of the impact on the supply chain, it does seem, and I mentioned Ryan Peterson, he said, they're already talking to a lot of clients who are like, we got to get product in here before we get hit with another round of tariffs. So that just adds to kind of weirdness in the data and sometimes like the pig through the python kind of thing going on. So, and I want to give you credit because I believe you said, I think you said this on mic. In fact, I'm pretty sure that you thought that retailers might use the tariff refund thing as a promotional tool. And I don't know if you saw that Costco said that they were going to do a promotion basically saying, we're getting our money back and we're going to pass it on to you. So I think Costco just keeps winning the narrative here on kind of sliding into people's DMs or social media to poke a little bit at the administration.
What I'm keeping an eye out for, New York City has just proposed that they raise the minimum wage in the city, in the metropolitan area, to $30 an hour. Now, at first, that's kind of an eye-watering number, $30 an hour as a minimum wage. Now, speaking as someone who has been a lobbyist in and around for retailers around the minimum wage issue, actually in the minimum wage issues, there can be some good news for retailers because, folks who are making the minimum wage, they can start spending more money at retail stores. They start to actually get beyond necessities and get to things that they might like to have. And the reality is in New York City, the average, I think, minimum wage now, though, by law is like 17, but it's actually probably more like, many people are saying, oh, look, I'm already paying people $25 an hour to keep them anyway. So it's an interesting, we saw this in California when they bumped up the minimum wage in fast food workers to 22. There was a great calamity declared by the restaurant industry, but the reality is they couldn't find enough people anyway. They started to adopt more technology. So anyway, this isn't an overnight thing. Apparently it would phase out, particularly for small restaurants or whoever retailers until 2032. So kind of a gradual rise. But, listen, it's tough. I've been to New York, and every time I go to New York, I'm like, how do people live here who are just, serving me my coffee? How on earth do they survive on those wages? So something to keep an eye on. And as I said, there's always for retailers an upside to minimum wage, whereas, as I said, people can actually have more money in their pockets to spend. So that's a wrap on our show. Let's leave it there.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to StephenPDennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.
You want oil to live above 60 but below 90. And don't get me wrong, we're still printing money at 90, but gas gets up over $3.50 a gallon, it starts to pinch. It hits 100, every product in America has to readjust its price. $78 a barrel, that's about perfect. It brings enough profit to keep exploring, but it don't sting as much at the pump.